Smart people often make poor financial decisions, not because they lack intelligence, but because they trust their thinking too much. The market is not always the problem. The most powerful force shaping financial outcomes is often the mind making the decision. Human brains evolved to survive uncertainty, not to optimize long-term wealth. To cope with complexity, the mind relies on shortcuts that feel efficient and reassuring. These shortcuts work well in daily life, but they quietly distort financial judgment. Most financial mistakes do not come from ignorance. They come from invisible assumptions that feel obvious and therefore go unchallenged. Over time, these small mental errors compound into major financial consequences. One of the most influential of these shortcuts is confirmation bias. Once a belief forms, the brain begins to protect it. Information that agrees is welcomed, while information that disagrees is filtered out. This bias affects how people read news, interpret data, and remember outcomes. Evidence that confirms existing views feels credible and well-reasoned. Contradictory evidence feels flawed, exaggerated, or untrustworthy. In financial decisions, confirmation bias turns research into reassurance. Investors often believe they are being thorough when they are only being selective. The result is confidence without balance. A person convinced an asset will perform well naturally gravitates toward positive analysis. Critical perspectives are ignored or dismissed as pessimistic. Over time, risk becomes invisible. This bias is especially dangerous because it feels like rational thinking. The individual feels informed, prepared, and confident. In reality, the decision has already been made. Anchoring bias operates more subtly, but with equal force. The first number the brain encounters becomes a reference point. Everything that follows is judged relative to that initial anchor. A historical price can define what feels expensive or cheap, regardless of present conditions. An initial valuation can shape perception long after it has lost relevance. The anchor remains fixed, even as reality changes. This causes people to wait for prices that may never return. It can also push them to overpay because a current price feels low compared to the anchor. The judgment feels logical, but the reference point is arbitrary. Anchoring affects salary negotiations, property purchases, and investment decisions alike. Once a number enters the mind, it quietly controls expectations. Resetting that anchor requires conscious effort. Loss aversion introduces another layer of distortion. Losses feel more painful than gains of equal size feel rewarding. This imbalance leads people to protect what they have, even when it no longer serves them. Financially, this creates a strong reluctance to sell at a loss. Holding feels safer than admitting a mistake. The emotional cost of being wrong outweighs the rational benefit of moving on. Loss aversion does not care about future outcomes. It focuses on avoiding immediate discomfort. As a result, people stay in situations that are quietly eroding their long-term position. The sunk cost fallacy reinforces this behavior. Money already spent begins to feel like an investment that must be defended. Past decisions start to dictate future ones. Time, effort, and identity become entangled with financial choices. Walking away feels like wasting what has already been committed. The brain treats irreversible costs as if they are still recoverable. This leads people to pour more resources into failing ventures. Each additional commitment feels like progress. In reality, it deepens the trap. Together, these biases create a powerful internal resistance to change. They encourage consistency over accuracy. The mind prioritizes emotional comfort over objective improvement. What makes these forces dangerous is their invisibility. They do not announce themselves as errors. They present themselves as reasonable judgment. Most people assume poor financial outcomes are caused by external forces. Markets, timing, or bad luck receive the blame. Internal decision processes remain unquestioned. In reality, long-term financial outcomes are shaped by repeated patterns of thinking. Small biases applied consistently have enormous impact. Wealth is often lost quietly, one rationalized decision at a time. Overcoming these biases does not require superior intelligence. It requires structure. Systems are more reliable than intuition under pressure. Clear rules reduce emotional interference. Checklists force decisions to pass objective criteria. External perspectives introduce friction where the mind prefers certainty. Accountability also matters. Explaining decisions to others exposes weak assumptions. Bias thrives in isolation. The goal is not perfect judgment. The goal is fewer unexamined decisions. Progress comes from slowing down automatic thinking. Financial clarity begins with recognizing that the brain is not neutral. It is persuasive, protective, and often misleading. Understanding this changes how decisions are made. Markets do not sabotage financial futures. Minds do. The first step toward better outcomes is seeing the trap. Want to see the hidden rules shaping money, power, and human behavior? Subscribe to Unseen Forces.